You have built something. The phone rings, renewals are coming in, new clients are showing up, and somewhere in the last few months, you started feeling it. The work is bigger than you can carry by yourself anymore. This training answers one specific question. When do you actually pull the trigger on hiring your first agent? Not when does it sound exciting, not when does it feel ambitious. When are you actually ready? And what should you do in the 90 days before the hire to set them up to succeed? Here is why this matters for your business. Your first hire is the single most expensive decision you will make in the early years of building an agency. Hire too early, and you burn cash, leads, and your own time training someone the business cannot yet support. Hire too late, and you cap your own income, miss enrollment windows, and burn yourself out trying to do every role. The fear that holds most independent agents back is not the cost of the salary or the override split. It is the worry that the new agent will not produce, will damage client relationships, or will leave after 12 months with your playbook in their pocket. That fear is fair. The technique here addresses it head-on by making the hire dependent on the business, not on hope. There are 3 signals that tell you the business is ready for a hire. You need at least 2 of the 3 to be true at the same time. One signal alone is not enough. Signal 1 is revenue capacity. Your trailing 12 months of personal commission income, after expenses, needs to comfortably cover your own household, plus an additional $50,000 to $70,000 in agent compensation, lead spend, and onboarding costs. If the math is tight before the hire makes it worse, not better. Signal 2 is lead surplus. You are turning down or losing leads because you cannot get to them inside 48 hours. This is the cleanest signal of all. A lead that sits for 3 days is a lead that bought from someone else. If you can identify 10 leads in the last 90 days that died because you were too busy, you have a lead surplus problem, and a second producer solves it directly. Signal 3 is hour saturation. You are working more than 50 hours a week, and the calendar is still full of low-value tasks. Application processing, follow-up calls on quoted business, basic plan questions from existing clients. If a junior agent could do those tasks at 60% of your speed, your time is being wasted on work that should not be on your desk. 2 of those 3 signals at once is the green light. 1 signal is the yellow light, and the answer is usually a virtual assistant or a part-time helper, not a full producer. Before we go further, we have to address the agent versus virtual assistant question. Many independent agents jump straight to hiring a producer when the actual problem is administrative. A virtual assistant at $20 to $25 an hour can take application processing, scheduling, lead intake, and renewal paperwork off your desk for less than $1,500 a month. A new producer costs 3 to 5 times that. If your 3 signals are mostly hour saturation driven by paperwork, hire the VA first. If your signals are lead surplus and revenue capacity, hire the producer. A useful rule: the first 2 hires in any insurance practice should be a virtual assistant and a junior producer, in that order, separated by 6 to 12 months. The VA frees you to sell more. The selling more produces the revenue and lead surplus that justifies the producer. Once the signals are green, the next decision is structure. There are 2 paths for a first hire: the 1099 independent contractor path and the W-2 employee path. They are not interchangeable, and the wrong choice creates legal and financial problems that take years to unwind. A 1099 producer is paid on commission only, controls their own schedule, runs their own book, and you receive an override on their production. They are not your employee. You cannot dictate their hours, require them to attend your meetings, or restrict them to your carriers. The upside is low fixed cost. The downside is low control and slower ramp. A W-2 producer is your employee. You pay a salary or salary plus bonus, you control their schedule, you train them in your process, you require their production, goes through your agency. The upside is full alignment and faster ramp. The downside is fixed cost from day one, whether they produce or not. For most first hires, the 1099 override structure is the right answer. You cap your downside. You attract experienced agents who already have a license and a personality fit. And you build the muscle of leading a producer before you take on the financial weight of payroll. Always work with a tax professional and an employment attorney in your state before you finalize the structure. Now, the part most independent agents skip. The 90 days before the hire are more important than the hire itself. In the 90 days before your first agent starts, you have to do 4 things. 1. Document your sales process, end to end, from lead intake to enrollment to first 90-day check-in. A simple Google Doc or shared note works fine. The new agent cannot read your mind. 2. Build a lead handoff system. The new agent gets a defined slice of the lead flow, not your scraps. Decide in advance whether they get all new leads under a certain age band, or all leads from a specific source, or every third lead in rotation. Define it before they start. 3. Set production expectations on paper. By month 3, the new agent should be writing a specific number of applications per month. By month 6, a higher number. By month 12, a number that justifies their compensation plus a margin. Numbers in writing, agreed to before they start. No surprises. 4. Decide your training cadence. Most failed first hires fail because the principal stops training after week 2. You will meet weekly for the first 90 days, every other week through month 6, and monthly through month 12. Block the time on your calendar before you make the offer. Here is how this comes together for a real producer. You have written 450 applications in the last 12 months between Medicare Advantage, MedSup, and Final Expense. Your trailing income is solid. You are working 55 hours a week. You have lost about a dozen leads in the last quarter because you could not call back inside 48 hours. That is 2 signals strong: lead surplus and hour saturation. Revenue capacity is borderline. The right move is a virtual assistant first. 3 months later, with the VA handling intake and paperwork, you write 500 applications in the next 12 months. Now revenue capacity is comfortable. Lead surplus is bigger. All 3 signals are green. You spend 90 days documenting your process, building a lead handoff that gives the new producer all final expense, leads under age 70, setting written production expectations of 15 apps in month 3 and 25 in month 6, and blocking weekly Tuesday morning training time on your calendar. Then you make the hire. The producer is set up to succeed because the business is ready for them. The lead flow is defined, the expectations are written, and the training cadence is locked in. Common mistake to avoid. Do not hire a friend or family member as your first agent unless they bring a real producer track record from outside your agency. Professional accountability becomes nearly impossible, and the business relationship damages the personal one when expectations are missed. Another common mistake. Do not promise a fixed salary to a new producer who has not yet sold for you. Pay on production until they prove the model, then revisit at month 6. Your action step today. Pull your last 90 days of activity. Count the leads that died because you could not reach them in 48 hours. Count the hours you worked last week. Pull your trailing 12 months of net income. Map those 3 numbers to the 3 signals. 2 of 3 green is the green light, 1 green is the yellow light, and the answer is a virtual assistant first. 0 green is the red light, and the answer is to keep building your own book until the business is ready. The hire is not the goal. The business that earns the hire is the goal.